You can't have a conversation about house prices without first talking about interest rates. Don't turn off too quick, I'm going to walk you through this.
Let's look at what an interest rate is, where it comes from, and why it matters to you and the future home of your dreams. An interest rate is a percentage of a loaned amount of money that a lender will charge the borrower. Now let's meet the ultimate lender, the Reserve Bank of Australia. We'll call it the RBA. It's the bank for the banks. It's not actually a place you could just walk into for a loan. It's where the banks go to borrow money. It's the nation's central bank, a federal institution that is responsible for the stability of our currency and a thriving economy.
That's a lot of money.
Before banks can offer anyone a loan, they first have to borrow money from, you guessed it, the RBA. And this borrowing isn't offered free of charge.
Interest rates are required every time money is lent from one to another, whether that's the RBA to banks or banks to consumers. The current interest rate is 0.1%.
That means if banks were to borrow $100 at this interest rate, they would have to pay the RBA back $100.10. So why have interest rates at all? The interest rate is part of an arsenal of tools the RBA use to control the amount of spending and keep the economy strong and healthy.
The way they do this is through adjusting monetary policy, like the cash rate. Remember this term.
On the first Tuesday of every month, except for January, the RBA meet to discuss whether to change or keep the current cash rate, which is basically the interest rate the banks have to pay on money they've borrowed from the RBA. If the cash rate is low, a bank will borrow more from the RBA and are therefore able to give us a loan at a lower interest rate. This encourages people and businesses to buy more properties. But if the cash rate has been raised by the RBA, then the banks will borrow less, meaning they will have to increase the interest rate on consumer loans, making them less attractive. Banks look at this cash rate and set their interest rates accordingly. That's when you hear things in the news about banks passing on interest rate cuts to those with loans. So why are they doing this? The RBA raise or lower this cash rate to control the rate of money flowing into the economy. So essentially, the RBA is in the driver's seat, and they can either step on the gas or slam on the brakes based on what they think they need to do to keep inflation in their sweet spot of 2 to 3%.
Are you still with us?
There's a lot to take in, so let's save inflation for a whole other video. If we look back to the 90s, the cash rate was up at 18%, meaning it was pretty expensive to get a loan at the time. Right now, the cash rate has been set to 0.1%. The RBA is happy for everyone to have easy access to loans so we can keep our economy moving during the tricky times brought about by the pandemic.
So now the question you're all thinking, who cares if interest rates are low or high? How does that impact housing prices?
When interest rates are low, like they are now, it generally encourages prospective buyers to enter the market, either for the first time or to buy an investment property. Instead of 5 people being at the auction for the 2-bedder apartment near you, there's now 50. It's even convinced people who are worried about the economic effects of COVID-19 to jump into property. When it comes to property, there are so many financial terms flying about in the media.
Now that we have a handle on what interest rates are, I think we might be ready for what's waiting around the corner.
In the next video, we'll look at the economics of negatively geared investments and how this tax incentive has contributed to the soaring house prices we've become so used to.